Hi, Dwayne. Since we have three, I'm unmuting right now. So the meeting's being recorded and I'm unmuting. And the first thing we'll do is swear in our new board member. Podium only.
Please raise your right hand and repeat after me. I, Kenneth Sugden,
I, Kenneth Sugden,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support, protect, and defend
that I will support, protect, and defend
the Constitution and government of the United States
the Constitution and government of the United States
and of the state of Florida
and of the state of Florida
and the charter and ordinances of the city of Palatka,
and the charter and ordinances of the city of Palatka,
that I am duly qualified to hold office
that I am duly qualified to hold office
under the Constitution of the state,
under the Constitution of the state,
and that I will well and faithfully
and that I will well and faithfully
perform the duties
perform the duties
of Firefighters Pension Board member
of Firefighters Pension Board member
on which I'm about to enter.
on which I am about to
So
enter.
help me God.
So help me God.
Welcome aboard, sir.
Thank you.
So I'll do roll call. Chad Branford.
Here.
Art Leary.
Here.
Justin Campbell,
Present.
Mark Lenity. Kenneth Sugden.
Here.
We have a quorum. The first order of business is to elect a chairperson pro tem, which just means someone who chairs when the chairperson happens to be absent, and a secretary whose duties are, so far I've seen you sign a document, and that's about all you do. So if you want it, you have to elect among yourselves with Commissioner Campbell to fill those positions.
Jill, this is Commissioner Campbell. I will fill in wherever the need is. So I'll roll with whatever.
Okay. Yeah, somebody has to make a motion first to, you can either do a slate of candidates or you can do each candidate individually for the positions.
Representative is basically.
He can be a chairperson.
Could you make sure that the mic is on? I'm having a hard time hearing him, officer.
Yeah. Each of you need your mics on it when you go to talk. You can, what I said is you can have a slate of candidates. Any of you can be in any of those positions. You elect each other into the positions.
So we'll entertain a motion to elect a secretary.
Yeah. So, who wants to be secretary?
I'll do it.
All right. So second on the motion.
I second.
And then
All in favor?
Aye.
Aye. Any opposed? Motion
Jill, who was that? Who did they elect?
they elected Art Leary.
Okay, great, thanks.
So make a motion, chairperson, Chad Branford.
Have a second.
I second.
All in favor?
Aye.
All right.
Opposed? Motion carries unanimously.
And the final is the pro tem, the person who handles the job when the chairperson can't make a meeting.
Motion to.
Can we elect someone that's not here?
We can use Kenny.
Okay.
You,
that's
you
fine.
can.
Motion to have Chairperson Pro Tem Kenneth fill that position.
I'll second.
Well, point of clarification as well as a point of order, that person would have to accept the nomination in order to move forth with the appropriate approval.
I accept.
All in favor?
Aye.
Aye. Any opposed? Motion carries unanimously. Ms. Jill, are we on the minutes now?
Yes. Has everyone seen the minutes? Have a copy? They're in the packet that you have on your desk. If you're comfortable with the minutes, then if someone would make a motion to accept them.
Motion to accept the minutes as presented.
I have a second. Second.
Second.
Motion,
All in favor?
say aye.
Aye.
Any opposed? Motion carries unanimously.
We are now on the third item on the agenda. Sarah Carlson is going to present the experience study. Patrick is not available today.
Yeah, good morning. As Jill mentioned, my name is Sarah Carlson, and I'm one of the actuaries at Foster & Foster, filling in for Patrick today. He's on a much needed vacation. He's traveling out west with his family, doing whole tour of the West Coast of America before his daughter goes on to college in the fall. So I'm pretty excited for him. So thank you for having me in his place. Yeah, I was just going to ask if Jill, are you in control of the screen?
Yes, I am.
Okay, thank you. Yeah, so I will just call out page numbers then, so everyone can follow along. I don't know if how many of you actually know what an actuarial experience study is. I'm sure Patrick did a great job of explaining what one is, but just to refresh everyone's memory, we do these experience studies to take a look at our actuarial assumptions utilized in the valuation and methods, such as the demographics of the plan, how many people retired, how many people terminated, or what the salary increases actually were compared to what we're utilizing in our valuation as far as our expectations, to make sure everything is in line, that we're not deviating too far from what is actually happening, because that would in turn lead the contribution requirements to be pretty volatile if we were going too far against what we're assuming. So we like to do these experience studies at least once every 5 years, just to do a checkup on what we're assuming. The last one for this plan was about 2016, so we're right on track, a little bit over, but that's all right. And then just to keep in mind that I'm going to be giving you, as we go through the report, tables of what the experience was compared to our assumptions. And then following each section, there's going to be some type of table showing what the contribution requirements are currently under for the plan and what they would be as a result if we were to change the assumption. And all of these impacts are based on the October 1st, 2021 valuation, because that's the last one we have. However, should the board approve the assumptions that we're recommending, we wouldn't be revising any valuations, causing any extra expenditures, and having the city revise their budgets, we would just make these changes implementing in the October 1st, 2022 actuarial evaluation next. So that being said, let's just kind of dive into the report. A lot of caveats in the beginning, so we can just start on page 4. Of course, the first part of our report is probably the most technical out of the whole thing. So just bear with me on these first 2 sections before we get really into the plan demographics. The first 2 sections starting on page 4. Oh, it's page 4 of my report, but I guess it's that'd be page 6 of the PDF or 7. I apologize. There's page numbers that aren't matching up with the PDF numbers. So yeah, that one right there. So the first 2 methods that we looked at were how we are amortizing our unfunded actuarial accrued liability, and then how we're actually funding for these participants' benefits. So our unfunded
Jill, can you go back up 1 page? It's showing.
Yeah, so we can just look at this
Thank you.
one. Thank you. So this schedule shows us any changes that we had in our unfunded actuarial accrued liability going back to 2004, increases due to benefit changes, assumption changes, method changes, and then any actuarial gains and losses. So each year when we do the valuation, if there's any increase or decrease in the unfunded or actuarial liability, we would amortize it over a certain period, kind of like a mortgage. So you see in that 3rd column there, we have years remaining, and it's kind of all over the board. And that's just due to our current methodology of amortizing these changes. We amortize them differently, whether that's an actuarial gain or loss or a benefit change. And the current method is 20 years for everything except for 30 years for benefit changes. But since we had last done this experience study, the Conference of Consulting Actuaries, who we look to for guidance and advice, has said that since then that maybe a better amortization period would be somewhere between 15 and 20 years. Anything over 20 years might be deferring too much to future taxpayers, and anything less than 15 would be too volatile. So going forward, we're proposing changing our methodology instead of that 20 and 30 years, just everything over 15 years going forward. So if you want to just scoot down to the next page, Jill, there's nothing too interesting. There's no impact of this right now because we're not refinancing or consolidating anything going back. It's just going forward, any bases that are established are going to be over 15 years. So there's no immediate impact of this new method that we're proposing. The next method is the entry age normal cost allocation. So this is how we're
Just a
determining.
quick question, ma'am.
Oh, sorry. Yes, please.
Sorry, ma'am. Just a quick question so I make sure that I understand. Right now, the methodology we use is a 20-year and a 30, right, for benefit changes.
Yes, sir.
And the idea is you propose to change that somewhere between 15 and 20, and then
We're actually just going to proposing doing a flat 15 years for everything going forward.
And so you'll have to just help me understand, or maybe you'll get to it. What does that do for us in the long run? How does that help or hurt the plan?
It's just attempting to make the contribution requirements a little less volatile, and not deferring too much to taxpayers. So the biggest change, I think, is your benefit changes right now. Anytime there's any type of benefit improvement or reduction, we are amortizing that change, paying it off over 30 years, which we think, or the CCA, the Conference of Consulting Actuaries, is saying maybe that's pushing off too much into the future. So we're consolidating that now into a 15-year amortization period. So long-term, it's going to be paying off these debts a little bit quicker.
So Sarah, if you look at the last entry on the amortization schedule on page 4, that was a 30 year. So that was actually recent. So that number, this rather than being 16,000 would be 32,000.
Correct.
I mean,
yep, it's paying it off quicker and paying less interest on that benefit change is
And
what we're proposing going forward.
And then contrary-wise, the deduction that's above it would be a third more.
So just, I want to remind the board that we're not changing any of these past bases, but yeah, as an example, if we were to have any type of actuarial gains like we did last year, that second to last line, we had this credit, our unfunded liability shrank by about 278,000. And instead of getting that credit for 20 years, we'll be getting a bigger credit for 15 years. Does that answer everyone's questions?
So maybe I made it worse.
It's just changing the way that we're paying off these debts or making these credits true up. Instead of over 20 and 30 years, we're just making it a flat 15 years. And we're not changing anything in the past. It's only going forward. So there is no impact. But yeah, I think the biggest change would be that benefit change is going from a 30-year mortgage to a 15-year mortgage now. And it looks like we have had a couple benefit changes in the past, one just recently this year, as Bonnie pointed out at the bottom, and then one a few years ago in 2018. But it's not changing these currently that are on the schedule. It's just any new ones that come up, how we're going to be changing that.
And am I correct in saying that this is only on the unfunded actuarial liability?
Yes. Any changes in the unfunded liability due to benefits improving or reducing or actual gains or losses would now be paid back over 15 years instead of your 20 and 30.
So Sarah, so that's not costing us anything? Because when I think as an old banker, when I think of going from 30 to a 15-year term, yeah, I'm going to pay 15 years less interest, but my monthly costs are going to double.
So it just depends on what happens in the future, to be honest. Right now is not costing the plan anything because we're not changing what happened in the past. But going forward, yeah, if we have a benefit improvement in the future, instead of paying it back over 30 years, you're right, we're going to be paying it back a bigger payment over 15. But then likewise, if we have any types of benefit reductions, we're going to get, a bigger credit going forward. So it just depends on where the plan is going in the future on how you look at it versus cost versus savings, which we can't tell at this point. But we feel that 15 years is the most appropriate for paying back these unfunded liabilities.
And isn't it correct that the city is the one who ends up paying these unfunded liabilities through their contribution?
Yes.
Okay.
Yeah, anything I'm showing you throughout this report, when there is an immediate impact, would be on the city's contribution requirement.
Sarah, is this something that, is this across the board? Is this a normal? You understand the question?
Yeah, no, absolutely. So
Accepted
it's my
practice?
understanding that several years ago, the state kind of implemented their standard of we called it a 10-20-30 method, where they were recommending we amortize everything differently, whether it's an actual gain or loss or assumption change or benefit change. But that was several years ago. So that's why we had this different amortization periods for different bases. But now, whenever we have been doing experience studies for our plans, each one since that white paper, that documentation came out that I referred to earlier, where we look to guidance from the actuarial Conference of Consulting Actuaries. Once we do an experience study for a plan, we do change our amortization method to a flat 15 years. That is definitely standard amongst all of our plans. I hope that is a long-winded way of answering your question.
And then may I just ask one more?
Yes.
To Mr. Leary's point, if we change from a 15 to a 20-year to a 15-year amortization, does that make our plan any less viable? I mean, you know what I mean? Are we still sustainable if we calculate like he said, if the payment doubles, can we afford the payment? Is that, we're not,
Well, again, it just depends on if there's any benefit improvements coming up. I don't know. It's right now, it's not changing anything, but as far as your first question, sustainable, I think it makes it more sustainable because you're paying off these debts faster and paying less interest. But as far as your annual payment, it just depends what's going to happen. If you're foreseeing major benefit improvements in the future, then yeah, it's going to make them a little bit more expensive in the short term. But on the contrary, it's also taking your gains and losses down to 15 years, where if we have a credit or an actual gain, we're going to be getting a bigger offset short term as well. So it all just depends on where the plan is going in the future.
yes, ma'am.
But Sarah, it's not going to immediately change their payment. That $311,000 payment will remain, and it will incrementally change because you're only changing. So when you do the 22 valuation, whatever the results are that require an amortization, require you to amortize the changes. So if there's a gain or probably a loss, you will just amortize it over that shorter period.
Correct. Yeah, it's very important to know that there's no immediate impact. We're not consolidating anything. We're not changing our mortgages that have been established in the past. There's no immediate impact to this at all.
Okay, so we may not see an impact for another year. Would that be correct?
Yeah, I mean, if you don't do any benefit changes, you're not going to see any impact. Again, Bonnie mentioned, in our 2022 valuation, any type of actuarial gain or loss would be amortized over 15 rather than 20. But that really isn't terribly significant. But yes, that would be a change, but it's nothing that is going to happen. There's no immediate impact on your 2021 valuation. It would just happen your 2022 for future gains or losses.
Okay. And Sarah, one other thing, you said that this is an appropriate change. So is this type of change you make based on the information you get from the actuarial organization?
Absolutely. Yes. The Conference of Consulting Actuaries, actually that first paragraph that Jill has up on the screen, they came out with a guidance, an updated guidance on how public sector plans should be amortizing any changes in the unfunded liability. And they gave a recommendation of between 15 and 20 years.
Okay, thank you.
Okay, if there's no more questions on that section, I'm going to move into probably the most technical methodology that we had to look at. And it really just has to do with how our actuarial evaluation software has been updated recently. And how we're funding for each individual firefighter's benefit. So let me just walk you through an example. When a firefighter comes into the plan, what we do as the actuaries is we project out what their retirement benefit's going to be using all of our assumptions. And then we calculate what that total present value is. And then to be able to fund for that, our job is to try to tell the city what a level amount is going to be to fund that benefit over their period of employment. So we gave an example here, hypothetical employee. That's exactly where I want to be on the screen. A hypothetical employee that was hired in the middle of fiscal year in April of 2021. They had a $42,000 salary, and their retirement date is 10 years later at October 1st, 2031. Their projected retirement benefit is roughly a little over $14,000. And then the present value of that benefit at retirement is a little over $165,000. So the way that we're currently doing it, or the way that our valuation software only allowed us to do this, is to divide that amount by how many years we're expecting the firefighter to work, which our valuation software was currently rounding the ages from, so this person entered in April, but it was actually saying that anyone entering the fiscal year is going to have a higher date as of that valuation date. So October 1st was this guy's entry date for purposes of valuation. So as the actuary, we looked at this total value of benefit of 165,000 and we divided it by 10 years. He worked from October 1st, 2021 through his retirement date of October 1st, 2031 to get this level amount that we're telling the city to put in. And that's that bottom number, that normal cost is what we call it, of little over 16,000. And then currently, what our valuation software is now allowing us to do, and if you want to just scroll down just a little bit so we can maybe see both of those. Yeah, that's perfect. So now our valuation software, instead of saying that anyone entering the plan in the middle of the fiscal year has to have a start date right on the valuation, we can actually say his true entry date is April 1st. So now instead of saying his period of employment is only 10 years, from October 1st, 2021 to October 1st, 2031, we can say he's working about 10 and a half years. So we're now spreading out the funding method or the funding span from 10 years to 10 and a half years, therefore lowering the amount of that equal amount we're telling the city to put in. So what that does is it lowers that normal cost from a little over 16,000 to 15,758. But then it's also increasing the accrued liability because he's coming in now with a half a year of service. So it's going to get us the same results at the end of the day, but it's just a different way that we can fund for this benefit. It's giving the city a longer period of employment, more appropriate and more accurate, to be honest. Does everyone follow me on that? Because it's very probably too technical before I move on to the impact. So what this does to the impact on the city's contribution is because it's just an offsetting effect, that normal cost went down and then the accrued liability goes up a little bit. So the offsetting effect is we have the city's contribution went down by 0.4% of payroll due to this new method, but our accrued liability or unfunded liability goes up slightly. So we feel like this is more appropriate now that our valuation software is allowing us to use exact ages rather than rounded ages. It also generally brings good news when we do these reports because the contribution requirements are going down in the short term as a result of a new method. Any questions on that one? All right, let's move into some of the fun stuff. Going into economic assumptions, there's two main ones, your investment return assumption and your salary increases assumption. So if we want to flip to the next page, Jill, please, I'll start with the investment return. And this, we're going to have maybe a more, that's perfect, a little better discussion at the end, because I do rely heavily on the investment consultants' advice as well. But right here, we're showing you what the plan's current target allocation is, the long-term expected returns per asset class, and what we're expecting the plan to receive as a return long-term based on that. And if you look at the bottom, it's just a little over 8%, which completely justifies your current 7.5% assumption. So this chart does justify it. However, we have seen across the state this trend of lowering that investment return assumption. FRS is currently at 6.8% right now. So for illustration purposes, we are going to show you the impact if you did want to lower it to 7.25% or 7%. And I should have mentioned this earlier, but at the end of the report, I summarize what the impacts are with each of these changes that I'm discussing. And then that's where we'll also show the impact of the investment return assumption and then start a conversation of where we want to go with that. Any questions on that one before I move on to salary increases? Those impacts will be shown at the end of the report to lower the investment return. Okay, so the next page, Jill, is the salary increases. So currently, we have a service-based salary scale assumption for this plan. We use this assumption to project what the retirement benefit is going to be at normal retirement. And we have this salary scale that is anticipating larger salary increases earlier in employment and then kind of tapering off during the later years. So this chart right here showing you the actual increases versus what we're currently assuming. So I really like to hone in on the last 3 columns when we look at these. And then we break it down by years of service. So you can see in the first year of service, on average, and this is looking at the last 10 years of experience, on average, there was very large increases, well over 20%. But we were only expecting 10%. So that's in those second to the right columns over there. So yeah, expecting 26% or expecting 10%, but we actually on average received 26% in their first year of service. I'm told, or I was told from Patrick, that there was a lot of outliers, at least in the last couple years, that skewed that number heavily. So instead of going all the way up to that, 26%, we are going to propose increasing it, but just increasing it to 12.5%. We do want our proposed assumptions to kind of mirror what happened in the past, but they're also long-term assumptions that we want to keep that in mind as well, and not let any outliers skew that. And then after the first year of service and the second year of service, we were almost on target, on average, a little over 5.7%, but we were expecting 5%. So we're proposing meeting kind of in the middle to 5.25%. For the next years of service between your 2 and 15 years, we expected almost 5%, but we actually on average received a little over 5.34%, but we're going to keep that at 5% for the time being. And then after 16 years, we did see actually a lower than expectation. We were assuming 4.75% going forward, but on average, it was much lower than that at 3.79. So we're going to lower that assumption to kind of get more in line with the experience to 4.5%. It's been my experience that we don't really typically like to lower them much lower than 4.5%, especially given the economic environment that we're in, inflationary concerns and everything. It is more conservative to keep it there. So we feel that that is an appropriate assumption for that time frame. So you want to scroll down just a little bit, Jill, please. So what does that do to our contribution requirements? It actually is going to lower them slightly. The biggest change that we made here is we lowered the assumption for those with 16 or more years of service. We increased it slightly in that first year, but for the majority of members in the plan that have more than 1 year of service, we're lowering that salary increase assumption. So we're projecting now smaller retirement benefits in the future, thus in turn, giving the city a little bit of a break and lowering that contribution requirement down by 0.6% of payroll. If you were to make this assumption change only. As I go through the report, we're only showing the impact of each one isolated, and then we show combination effects at the very end. Any questions on the salary increase assumption before I move on? All right. The next 3 that I have, or the last 3 that I have to talk about are purely demographic assumptions, retirement rates, withdrawal rates, and disability rates. So your retirement rates on the next page, there was actually only 1 retirement in the last 10 years of experience. So since we didn't really have a lot of credible experience, if we had many more retirements, we might think about altering our assumptions. But right now, since there was only 1 retirement, it's not giving us any type of justification to change those assumptions. Right now, we're assuming that people are deferring retirement a little bit, notably in the first year, the 50% chance in the second year. And then once you're 2 years past retirement, we are assuming you're going to take that. But since there was only 1 retirement, we did not feel that there was need to change that right now, but we will continue to monitor that in the future. The withdrawal rates on the next page are your rates of separation of employment. These are the rates that somebody is going to separate employment before becoming eligible for retirement or by way of, or being disabled or dying. So right now we're currently using a service-based table as well, kind of similar to the salary increase, where we're assuming that people earlier in their years of service are going to have a higher probability of leaving rather than working a little bit longer. So you can see that experience right here in this table. Again, let's just kind of look in the last three columns where we had what actually happened versus what we're expecting to happen. And, you know, just looking at the bottom at the total, we actually had a higher rate of separation of employment than what we were currently assuming. So then we're proposing just adjusting those rates in the right-hand column to just get a little bit more in line with the experience, notably in the service starting at 10 years, and the bucket between 10 and 14 and 15 and 19. We're increasing that from 2% to 5%. And then at 20 years of service, we didn't see any terminations. So we're assuming once you hit 20 years, you're probably going to work until retirement, given that we have that 25 years of service requirement. So the impact, if you were to accept these changes, is shown at the bottom table right there. So since we're now assuming a higher probability of separation of employment, that's lowering the probability that people are working all the way until retirement and collecting that larger benefit. So it's going to decrease the contribution requirements as a result of that, namely by 1.6% of payroll if you were to adopt this assumption as well. Any questions on that one? All right, and then disability rates. Oh, yeah, there's not much to talk about here either, kind of like retirements. We're currently assuming a low disability incidence disability rates anyway, and there were 0 disabilities during this time period. So since there wasn't any credible experience and we already have very, very low rates, namely we were expecting less than 1 disability during the period, we're not recommending any changes to those rates at this time as well. So then the last page shows that summary or that menu of the different assumptions that I discussed. Now we're also showing the first 2 scenarios were if you were to just lower the investment return assumption from your 7.5 to 7.25 or 7%. And you see that would, just doing that would increase the requirements by 3.8 or 8% respectively. And then the next 3, your salary increases, your withdrawal rates, your entry age normal cost allocation, those are numbers you saw before earlier in the report if you were to just make those assumption changes, and what the impact would be on the contribution requirements. And then the last 3 options are if you were to make all of our recommended changes and then also lowering that investment return assumption or keeping it at 7.5%. So if you were to make all the changes, but keep your 7.5% investment return assumption, the impact would be a 2.6% decrease in the payroll as percentage of payroll. And then if you were to lower the assumption to 7.25 or 7%, and make all of our proposed changes, it would increase the contribution requirements by 1.3 or 5.4 respectively. And before I kind of weigh in or want you guys to weigh in on your thoughts or maybe even get the investment consultant's idea, are there any questions on this chart or anything else that I've discussed thus far? So it would be our recommendation, you know, to either go with number 6, 7, or 8. You know, this is kind of a menu for you all to decide. We make recommendations and you approve the assumptions as a result of this. Our recommendation would be somewhere between 6, 7, and 8 based on the experience that we've shown you. It's just a matter of how you want your investment return assumption to change. Are there any thoughts or questions on that one? Have we had discussions before on lowering the investment return here?
We have. I would ask Mr. Dwayne I'd like for him to weigh in on it. And if somebody from Burgess' office is available, man, I'd really like to hear from you.
Okay, this is Dwayne Madron, Capital City Trust. 7 or 7.25 is achievable. It's hard to predict the future, but part of it right now has been bond yields. But they're coming back up, which makes it easier. Stocks don't have to work as hard. But I'm comfortable with either one, 7 or 7.25. I thought the expected return that the actuary mentioned for domestic equities was high, and I thought the international was low. I think domestic is closer to 6 and international is closer to 7, but that's just my opinion. But I think 7 is achievable.
And 7.5 is not.
It would be, it's such a small difference. It's hard for me to predict the future to that level of detail. But yes, 7.5 would also be achievable if 7 is, and 7.5. I mean, you're right there. If bond yields can get back to 4.5, it certainly is achievable.
Yeah, and this is Mitchell Brennan with BCA, calling in for Burgess. We're comfortable with either 7.5, 7.25, or 7. Obviously, we'll cater the asset allocation to meet any of those assumption rates. I think the best course is probably to meet halfway at the 7.25%. We've seen across the board the state pressuring plans to move their assumption rate down. FRS is at 6.8. But we do have some recommendations on a new IPS that we're going to present, adding some private real estate, which is, again, going to increase some of the income provided to the fund, reducing some of the fixed income exposure where we've had pretty limited returns over the past couple of years. And so we're comfortable with any of the three. I think if you're making multiple assumption changes currently, that it may be best to at least meet halfway and possibly reduce to that 7.25. But whatever the board decides to do, we're going to cater the asset allocation to meet those needs and achieve that at a high rate of conviction with minimal amount of risk.
And if if we want to go down to 7.25, there is a cost to that. It would increase the the contribution requirements roughly by 1.3%. And so just keep that in mind. However, we're not limited to just those 3 options. If you did want to eventually get down to 7.25, we could do that in steps. We could do halfway with the 2022 valuation and then halfway with the next. I have some plans that are doing that as well. So if that's the route that we want to go, rather than making the jump down to 7.25 now, just wanted to make that comment.
Jill, where are the the police and in the general?
The general decided, I believe, at the December meeting to be at 7.4. The fire and the police stayed at 7.5. But
Okay. So Dwayne, do you see any problem with, is it just standard operation to move these numbers at quarter percentiles, or like she says, the general went to 7.4? I mean, these are such minor changes. I'm just curious,
Yeah, that's they are minor changes, and I don't know that you can fine tune investment strategies to achieve 0.25 difference in return. And 7 is easier to achieve. I certainly would think you could get 7.5. I mean, not in the history of my career, it had been at 8, and that was a challenge. 7 is much easier. But yeah, these small changes are, they make a difference in the contribution rates, I guess, but it's so difficult to predict the future to that level of change.
And no, you were talking about the bond rates getting back up to 4 and
Yep.
or
I mean,
at 4.
Yeah, that would make it easier. And we're getting there. And we're also taking, I guess Burgess is going to propose to put some money in private real estate, and maybe the yield there will be higher than what bonds can return. But historically, and some of us can remember when bonds used to yield 5, 6, or 7. I mean, when I started in this business, I could get 7.5 on a A-rated bond, and now it's 2, or maybe, and today I'm getting 3.4 on a 1 year. So it's getting better, but it has made stocks have to work harder. And so I guess I'm optimistic to the point where bond yields are going up and stocks don't have to work as hard. And I also like a lot of the large cap companies in the index. They have an optimistic future, where in the past, the larger companies used to be made up of oils and the pharmaceuticals. Now they're tech, which has been helping because they grow faster. I guess what I'm trying to say is I'm optimistic you can meet 7 or 7.5.
Okay. I just, are you seeing, I mean, you said our bonds right now are around 2.
Well, on the short end of the curve, it's closer to 3 for a corporate bond, and a treasury is probably in the mid 2s on the shorter end. But I believe Sawgrass goes out a little further, so they might be able to achieve in the mid 3s. I'll let Sawgrass speak to that.
Okay.
Yeah, this is Lirdon Gila, portfolio manager at Sawgrass. To give you the most recent updated yield bogey, your fixed income portfolio is the most recent numbers is yielding roughly 4.25%, 4.5%. And because of the dramatic move in rates that we've seen recently, even for a short maturity corporate bond, you're actually getting a 4% yield right now. So it's become a lot more attractive, in terms of getting those attractive yields in the bond market.
Okay, thank you. Okay.
Miss Sarah, I have a question.
Yes.
Do you believe that the plan, if we were to assume the number 6 option, will the plan stay healthy at that assumption? Is it, you know what I mean? That my question is, are we doing the right thing if we stay there? Do we absolutely have or need to go down to keep the plan healthy? Right? That's our mission, is to keep the plan strong, correct?
That's correct.
So can we keep the plan strong there? Or do we have to change to keep the plan strong?
I mean, anything that lowers the contribution requirements, I would say you might want to lower it so that the contribution requirements are flat. I don't necessarily like not putting money into the plan. When you say, is our plan going to be healthy? Like, I like to see a little bit more conservative. I do have a lot of plans that are still at 7.5. Rarely do I have any above that. The median is more like 7.1, 7.2. But I know how this year might end up. So asking you to lower it and to 7.25 and increasing your contribution requirements in addition to possibly having an actuarial loss might not be the best play. So I think to answer your question, I would like to see the investment return lower to remain healthy. I would recommend somewhere between 7.5 and 7.25 for now.
Sarah, has the state reviewed their recent actuarial valuations and provided any kind of letter about the assumed rate of return?
I don't know offhand. I'd have to look that up, but I can.
We haven't received anything.
Okay.
I haven't
Oh,
received
okay.
anything.
Once every 3 years, and I don't know where you are in that 3-year cycle, the state does look at your actuarial valuations. And I would say, and Sarah, you can comment on this, without fail, they are providing, regardless of what your assumed rate of return, the state is indicating that they would like to see it lower, that their forward-looking assumptions on the market are trending lower.
Mm-hmm. Yeah, so I actually just pulled it up. We did receive one in early 2022 where they did do their triennial cycle through 2020 valuation. And they did approve the valuations, but they do have caveats saying that the assumption is high and they recommend lowering it. But their range is between 5 and 6%. And I think Bonnie can agree with me that we've seen this language in almost every valuation report approval letter that's come forward. And their recommendation is always seems really, really low. So just keep that in mind. I don't think they're not picking on Palatka Fire by any means. I've seen this boilerplate language in every acceptance letter, but they are recommending that to lower it from 7.5%. They didn't reject the reports, but they are making a recommendation to lower it.
And I think that ties in with what Mitchell was saying, is that, kind of the state wants everybody to trend to lower. So it's not necessarily whatever the number is, but looking for the trend.
This is Dwayne. May I say something? I did a quick calculation. This is kind of back of the envelope. But if equities return 8, and let's say 70% of the plan is in equity type investments, and bonds return 4, then the weighted average is 6.8. So but the 8% assumption on stocks is a little bit ambitious from the research that I read about capital market expectations. So I would say that that 6.8 would be, even based on 8% equity return, 6.8 would be a little bit difficult. Now that if stocks can return more than 8, then it'll be easier. But 6.8 is what I come up with.
And that's net of the inflation though, correct?
Right, that'd be nominal.
Yeah, that would be nominal.
So, Mr. Gita, would you consider the bonds in a rate increasing environment right now?
Well, we have reasons to believe that we are basically, I wouldn't say peaking, but there's a lot of these leading indicators that we're looking at, such as the ISM numbers, the weekly jobless claim numbers that are coming in, and they're all essentially rolling over. And some of that is already being translated into what the bond market is telling us. So we're starting to see signs that this huge runaway in rates and inflation numbers that we've seen in the last couple of months is definitely starting to moderate. So I would argue that we're near that towards the 8th or the 9th inning of this recent rally in rates. So I would say we're pretty much closer to the end of this major sell-off that we've seen in the last couple months.
Okay, thank you. And Sarah, where would we be if we just said the required city-state contribution was at 0%?
I mean, these are all approximate values because this change is based on the 21 valuation. But it would probably be about 7.3, 7.35 if you wanted your any impact due to assumption changes to be neutral. You could lower it to 7.3 and make all the changes. Or we could just back into that number in the next valuation, which isn't always fun, but we could do that.
Mhm. Okay. Yeah, because I agree with Dwayne. That's 6.8 to me is too much of a burden, but Dwayne, how would you feel about changing to 7.3 or 7.35?
After thinking about it and listening to everybody, I'm definitely on board with 7, because if the equity assumption is 8% per year, in my opinion, that's ambitious. And I'm looking at a lot of capital market expectations from different investment firms. I don't see 8 anywhere.
Okay, thank you, Dwayne.
Yep.
Yeah, I would just quickly add in, again, this is Mitchell with BCA. We also look at those capital market forecasts, and consistently they're inaccurate. So keep in mind that no one projected 10 years ago that the S&P 500 was going to average 14.5% for the past 10 years. So if it's a difference of putting a significant burden on the city's contributions, meeting halfway is not a bad option there. So you have to keep in mind that you want to be able to fund benefits, but you also want to have the opportunity to potentially increase benefits going forward. So don't put the plan behind the 8 ball by significantly reducing the assumption rate and increasing costs significantly for the city, and kind of hurting any negotiations going forward for any potential benefit increases or hires for the fire department.
And I wasn't there for the police conversation, unfortunately. But I looked at the meeting notes and they were kind of in a similar, I looked at the study and they were very similar, and they chose the combination and they kept the assumption at 7.5. Not that we need to do what police does. I'm not saying that, but I'm curious why as well. So, I know you asked where police in general were earlier. So I thought we did do a study for police, and they chose to keep the 7.5% assumption as well.
So Mitchell, your opinion would be 7.25 would be a good compromise and keep us in a good spot.
Yeah, absolutely. And even if you want to just take it down by 5 basis points a year and do it steadily so that the costs aren't magnified at one time, that's also an option. We have that with other plans where they're coming down from 8 or 7.75, and they're doing it in stages every year where they go down by 5 basis points or 10 basis points to get down to that eventual 7.25 or 7% number.
Okay. Joe, I'm just curious, who is on the police board?
Mayor Hill. Matt Newcomb is a new member. Tammy McCaskill. Yeah, I can't think of the other two right now.
Okay.
If you think of the payroll being $1 million and the current contribution rate just round to 30%, then the city's contributing $300,000 a year. By making it go up 5%, you're adding another $50,000 burden on the city at a time that your negotiations are also happening.
That's why I mean, looking at the numbers and in the city's current situation, that's why I was saying, at best, make a change where the impact on the city is just neutral for now, and then review it again next quarter or next meeting.
We can do that. I have a lot of plans that have chosen that option, so that's doable and appropriate in my opinion.
Yeah, so much of this stuff is an opinion based on trends, and it's like your house appraisal. People don't realize that's an opinion. That's one person's opinion, and you may know the true value, but someone else may not. So I just think it's a cautious step for us. Considering the police only moved it, 10 basis points, and the general didn't move at all, which I find that kind of.
I think it was the other way around. Sorry to interrupt, but general
Other way
moved
around.
it, but
Yep.
police kept it.
Yeah, I just not sure their reasoning behind not trying to make some kind of bigger change, but
So just so that I'm clear, if we keep this neutral, we still make our plan, we assume the rate of return is lower, right? That number has to change. That keeps our plan healthy with no impact, no significant impact to the city's budget. It's a compromise somewhere in the middle. Is that what we're really saying?
Yeah, so when we do next year's valuation report, as far as the impact due to any assumption changes, we will make it so that is neutral. There might be impacts due to actual gains or losses, but so the contribution requirements might go up or down as a result of that, notably market returns. But as far as changing your assumptions, we will make it so that there is no impact on the city's requirement due to that. And that would be incorporating all of our assumption changes and lowering it from 7.5 to, it will be somewhere in the 7.3 range, but we will do it so that we'll get that precise number once we do the actuarial evaluation next year. Does that answer your question?
Yes, ma'am. Thank you.
Just a change we can make today.
One of the reasons the meeting.
We can't hear the discussion.
I'm sorry. We did want to get the experience study accepted today, but that doesn't necessarily mean you have to accept a rate change today.
I've had motions made before where they accept all of our proposed assumptions with an investment return assumption that would make the impact neutral in the 2022 valuation. I don't know if that's
Okay.
allowable, but I have had that happen. I think that's allowable.
So
I'll let Bonnie
would-
chime in.
Yes, it is.
Okay.
we'll entertain a motion. Let's entertain a motion to accept the experience study.
Okay. So I'll motion to accept the experience study as presented with a motion to
Set the assumed rate at a neutral city contribution.
right. Exactly. Yes, ma'am. Thank you.
Second.
You're welcome.
Second.
Motion's been seconded by Kenny Sugden. All in favor?
Aye.
Any opposed? Hearing none. Motion carries unanimously. Thank you, Miss Sarah.
Thank you.
Next up, Sawgrass, correct? Mr. Leardon?
Yeah. Mhm.
Yes, thank you. Thank you. And good morning, everyone. Again, Leardon Gita, Portfolio Manager at Sawgrass. Today, I just would like to give you a quick overview on the fixed income portfolio for as of the first quarter. But because of the volatility that we've seen in the market, I thought it was more prudent to give you an update as of May. So if you flip through with me on page 9 and 10, you can see the performance for the year to date as of 3/31, but also you can get a more updated version of that as of May 31. You can see here we've got some negative absolute numbers, and there's no question that it's been a very tough start to the year for the bond market. It's actually the worst start on record, so you can kind of get a feeling in terms of the overall magnitude for the move. The bond market, as the most recently, is actually down close to 10% on a year-to-date basis. So that's a pretty significant move for rates and risk assets. So not just the bond market, but the risk assets in general have had a pretty tough year. Stocks included, spread products, everything is pretty much down. And the main culprit for this huge move that we've seen in the last couple of months has really been inflation. Inflation is the daily topic for capital markets. It's put a lot of pressure on the Fed to the point that they're basically coming to the media and jawboning the market on a daily basis, and they've forced the market to reprice a much more aggressive rate hike path in the near term. The most recent rate hike that they just implemented recently was 75 basis points. And just to kind of give you a perspective in terms of the magnitude of that move, the most recent move, the most recent 75 basis move that we saw was 30 plus years ago. So these are some dramatic times that we're seeing in the market with some elevated volatility across the board, not just the bond market, but stocks and spread products. Everywhere you look at it, it's just elevated volatility essentially. In terms of how we got here, we have the most recent print that we got in the CPI was roughly 8.6%. In terms of how we got here, I can think of the three main drivers that led to this accelerated inflation. The first was really the demand side. There's no question that the demand side of the economy was overstimulated by the fiscal policy and the monetary policy. We had a very aggressive stimulus package that was passed by the government in the last couple of years to the tune of close to $5 trillion that hit the real economy. We're talking, real money, sent to people's pockets. And so that really had a profound effect in the overall demand for goods. And that was also monetized so this was essentially an incremental debt added to the federal debt levels. And that was primarily monetized by the Fed side of the equation. If you look at the Fed's balance sheet, they did increase the balance sheet close to $6 trillion in the last couple of years. So we had this kind of a coordination, if you will, between the fiscal policy and monetary policy that really caused a huge shift to the overall demand side. So that was one of the biggest drivers in terms of the overall inflation. The second one was really supply driven. So we had an unfortunate, once in a century health event, and that's causing a lot of problems. And one of the main problems that we're seeing, and we've been seeing in the last couple of years, is really on the supply side of the equation. A lot of companies, a lot of industries, they have these globally linked supply chains, and we've seen a lot of disruption. One primary case that I can think of is in the auto sector. The chip shortage is really affecting the overall new car production to the point that it had a huge spillover effect in the used car markets. If I look at the Manheim used car price index last year, for example, that index went up close to 30% because of the lack of supply in the new car. So a lot of these moves are making their way into that CPI calculation, and that's what's causing this recent acceleration in the overall CPI basket. And then the third factor was really the run up in the commodities. We saw a historic move in a lot of the key commodities. It really started with lumber back in 2020. People speculating on this huge increased demand for single family home, driven primarily because of the COVID. People moving from the highly densely populated areas, high cost states into more southern states. We saw a huge increased demand for people moving into the suburbs. The single family home is not just a regular home anymore. It's also your office. A lot of people choosing to work from home. So we saw this tremendous increase in demand, and that caused a spike in commodities, lumber, and many other industrial commodities such as copper, aluminum, zinc. And that was followed by the oil run up that we saw recently. And it doesn't help when you have another major war, right in the heart of Europe. You've got the two biggest producers of the agricultural commodities, Russia and Ukraine, really affecting that market. And we all know that the food component of the CPI is close to 10%. So, all these things are just not helping. They're not helping to at least, reduce the pressure in terms of the overall trend. So you couple all these three mega forces, and that's how you got to, roughly an 8.6% inflation. Don't forget, this time last year, we were looking at a 1.5% inflation. So the run up of the inflation has been astonishing. Has been, it's caught everybody by surprise. You got to go back to the World War II to see this kind of acceleration in inflation. But nevertheless, if you kind of look at the current dynamics, I would argue that we're really not back in the 70s. We think that it's going to be, people hate to use the word transitory, but we still believe it's going to be transitory because it was primarily supply driven force that really moved the inflation to these levels. If I compare the current economy with the economy that we had back in the 70s, where we had a booming demographic and the debt levels were extremely low, that is completely to the current state of the economy, where we have an over-levered economy, highly financialized economy. The aggregate debt, if you combine the public debt, private debt, corporate debt, we're talking 350% of the GDP. The demographic is completely different from what we saw in the 70s. So, the propensity to have significantly higher rates from these levels is not there. So we believe that we're basically closer to the late innings of this huge rate move that we've seen recently. And as I mentioned previously, we started to see some signs of leading indicators that are pointing to the economy rolling over, to the point that now the market is starting to speculate on the timing of the recession. So we've moved from talking about inflation to now we're actually talking about recession coming into the horizon. So I would say that given the recent run up in rates, we're closer to the end in terms of this huge trend that we've seen in the rates moving higher. Some of the leading indicators, such as the trucking, shipping rates, container rates that I'm starting to see, ISM manufacturing, the new orders, these are all leading indicators that are pointing to the economy slowing down significantly, to say the least. So that is pretty much the current state. In terms of the implications for your portfolio, yes, it is true that your portfolio did take the hit this year. But if you look at it, for example, on page 10, as of these numbers are as of May, we were able to protect your portfolio a little bit on the downside. So, but unfortunately, still negative absolute numbers. But if you look at the 3-year and the 5-year, you're still looking at slightly positive numbers, and now your portfolio is yielding above 4%. So my point here is that yes, you've taken the hit, but in the next couple of years, because of this very attractive incremental carry that you got going forward, you will be able to make up that loss in just a couple of years. And then because of your long-term investment objective and horizon, you're actually better off having these higher rates, because this is the way to escape the financial repression, and you're going to be accruing at a much higher rate going forward for the next 10 years or so, if we believe that the rates are not going to move significantly from these current levels. So I think net, yes, you've taken the hit, but you will be able to make up that loss very quickly in the next couple of years. And then with your long-term objective, you're actually better off having these longer term, these higher rates, and compounding your portfolio at a much higher rate for the next decade or so. So that is the bright side of the story. One more thing I wanted to leave with you is on page 15. The bond market it's got two main functions. It's essentially trying to forecast the inflation and also the growth rates. It's not really, it is not like the stock market where you have the behavioral biases and, it's a little bit more of art than science. And, bond market is pretty science-based. And you can kind of see the math in terms of how the math works. These are the annual returns for the main bond market index. That is the Bloomberg Aggregate Index. And you can see going back in the 70s, it's very hard to find years where you're seeing negative total return for the year. Unfortunately, we've seen this year and the previous year, which it's somewhat of an anomaly to see two straight years of having negative returns. This year being actually the worst on record. But if the past is of any guide, you can make the educated guess that most likely going forward, the next few years are going to look pretty decent in terms of the absolute returns for your portfolio, given where we've been and where the rates are and how the economy is shaping up in terms of the next few years. So I would say, stay optimistic. The yield is pretty attractive, 4+%. You've got a high quality asset that is a true diversifier to your total plan. And finally, you're getting paid to own this high quality asset. So I would say going forward on a relative basis, the bonds are actually a little bit more attractive given where we are in the economy, and you're getting a decent yield. And most likely in the next couple of years, you'll be able to make up this initial hit that we've seen this year. So with that, I'll conclude my brief remarks, and I'll take any questions if you have any.
I don't have any questions. Thank you, sir.
Thank you.
Motion to accept Sawgrass report as presented.
I second.
Motion to accept Sawgrass, seconded by Kenny Sugden. All in favor?
Aye.
Any opposed? Motion carried. Next, Mr. Madron with Capital City.
Okay, good afternoon, good morning. I think it's still morning.
Yes.
Dwayne Madron, Capital City. And Jill, if you'll scroll down to the policy review page, we can look at the plan and how it's positioned versus the strategic model, underweight cash, because rates are higher elsewhere than cash, overweight large cap equities because at the expense of being underweight international, because business conditions here, I feel, are better than across the ocean. And also underweight to convertible bonds because the expected return on equities is higher than that on convertible bonds. So basically, the portfolio has been positioned to be overweight large U.S. companies that hold up well in a slowing economy. And that is what has happened. They're more diversified. They're able to raise their prices and to ward off inflation. That's the best way, is to use stocks as a shield because they're able to raise their prices. So the large companies, if you look at the top 50 largest companies in the S&P 500 index, they're all healthy, doing okay. Certainly they have pulled back because the fact that the economy is growing at a slower rate, and inflation and higher interest rates tend to cause growth stocks to fall. They're enemies of each other, but that doesn't last forever. So what has happened basically is that in a high growth environment last year, when inflation was low, stocks did well. Now stocks are revaluing and resetting their valuations to recognize a completely different investing climate. And so that's, largely why you see stocks falling so much. It's not because they're not making money. They're still making money. They're just making it at a slower rate. So this won't last forever. But this year is certainly not a good year for stocks or bonds. Jill, if you can scroll down to the performance page. So this is through the end of March. And that year to date, the fund on the equity side is down 5.5. And equities are down 5.98 through March. Of course, April was a bad month, May was a neutral month, and June is sort of a neutral month. You can see where bonds, the high yield bonds are down 4.3, real estate down 5.9. Real estate tends to act like a stock. What's interesting and what may jump out at you is over the last year, equity returned 5.9, but the S&P 500 returned 15.6. Why are we so far behind the S&P 500? It's because small cap and international and underperformance from the American funds, international, and the convertible bonds also drag returns down much worse than large cap. So if you look at year to date, the numbers are closer to each other. That's because large cap is finally rolling over a little bit, and small cap and international have stabilized. So over time, though, mid cap and small cap and international tend to perform closer to large cap, but that hasn't happened in the last 1 year. But each of the last 13, 14.39%, an outstanding return. The last 3 years in equities, calendar years, were the best 3 years. I think they returned 77%, the best 3 years in the history of the stock market. And it's been incredible. And a lot of that was because of the Fed stimulating the economy. And so now that's all going away. We're back to a normal environment. We're going to see returns more along the lines of 6 or 7 or 8% per year for equities. If you want to page down one more, we can see the returns at the end of April. And April was not a good month. So year to date, down 12.4. Equities are down 13.7. You can see high yields down 7, real estate's down 9. But you also see where the S&P 500 is much closer to equities. Again, that underperformance to the S&P 500 was international and small cap. So not a good year for stocks. And again, between now and the end of September, things could get volatile because there are some things out there, such as inflation and companies guiding their earnings estimate lower potentially in July, which could cause stocks to drop a little bit more. So this may not be over, but certainly in 2023, from what I'm reading, inflation should come back down somewhat, and that will help stocks. So if you page down a little bit more, Jill, we can look at the asset allocation of the fund, which is 58.9% equity, 33% fixed income, 5% real estate. It's a moderate growth portfolio. I'm going to keep paging down. The rest of the report is the holdings, the mutual funds that we use, Fidelity and Vanguard, American funds. You see, then we have the convertible bond ETF from Barclays. But really, that if there's any questions, I'll be glad to answer. That concludes my comments.
Entertain a motion to accept the report as read.
Motion to accept the Capital City report as presented.
I second.
Second by Kenny Sugden. All in favor?
Aye.
Any opposed? Motion carries unanimous. Next up. PCA. It's Michael.
All right, good morning. Please let me know if you have a copy of our report. And we can go ahead and start off on page 2. Again, my name is Mitchell Brennan, filling in for Burgess today. Unfortunately, he had some travel issues with all the flights being canceled yesterday. And so he is in the air as we speak. But I'm happy to go over our report and give you some updates through this second quarter so far. Obviously, we close out the quarter today. So I can give you a little bit of preliminary numbers for that, which unfortunately are not any better than what I'm going to report for Q1. But we do have as well a IPS update that we'd like to present to add a private real estate allocation to help with as an inflation head and provide some more income to the portfolio. And so I'm happy to go over that as well. But if you want to go ahead and flip over one more page to page 2, we've had great updates on what we've seen in the market so far, but I'll just highlight here. If you look at the very top, really for the first quarter of the year, unless you were commodity or energy related, you had a negative quarter. There was nowhere for investors to hide. We started to see a rotation in markets where growth has significantly outperformed value over the past few years, where value started to take the reins in December of last year, and that continued into the first quarter. And so at the very top, you'll see the only positive performance for the quarter was MLPs and the commodity index, up 19 and 25% respectively. Below that bottom left-hand corner, you'll see the different large cap growth and value indexes. And again, large cap outperformed mid cap and small cap, and value outperformed growth for the quarter. In the bottom right-hand corner, again, the only positive areas of the market, energy was up nearly 39% for the quarter. And then utilities with their inherent inflation hedge was up just shy of 5% for the quarter. So if we flip over to page 4 to highlight for the quarter, unfortunately, we're down about 528,000 or 5.1%, slightly behind the strategic model, specifically convertibles and within international, the American Fund Geo Pacific underperformed their benchmarks. And so that caused us to lag our overall strategic model for the quarter. But the best performer was the Cohen & Steers Global Infrastructure Fund. It was actually up 3.5%, so the one positive spot in the portfolio. And then right behind that, cash, obviously, we didn't lose any money there, so that was a winner. If we go out to the 1-year period, the plan has earned 374,000 or a return of 4.1% ahead of the strategic model over that time period, and led by the REIT fund up 21.4%. Your Global Infrastructure Fund by Cohen & Steers up 16.7%. And then our large cap Vanguard Institutional Index Fund up 15.7%. And then the few bullets below that, you can see for the longer term, numbers still look fantastic for the 3-year period. 2.6 million in gains over that time period, an annualized return of just shy of 11%, and ranked in the top 44th percentile of other public pension plans. For the 5-year period, 3.6 million in gains, annualized returns of 9% net of fees, and that ranked you right in the median of your peer group at the 52nd percentile. And then if we go all the way out to the past decade, the plan has earned $6 million or an annualized return of 8.1% net of investment fees. And I'll pause there for a second. Any questions on that update? Okay, we can go ahead and go over to page 7. And again, this just highlights those numbers that I just went through. But again, if you go all the way to that 10-year column for the past decade, despite having outflows of about 2.3 million over the past 10 years, you've offset that with nearly $6 million in gains and finished the quarter at 9,756,000 in assets, or an annualized return net of investment fees of about 8.1%. So unfortunately, a quick update. So pulling current market values through yesterday's market close, so 6/29, we were down to 8,744,000. So that's a loss of just over $1 million since the end of the March 31st quarter. From a percentage standpoint, that's down about 10%. So on a fiscal year-to-date basis, from October 1 through yesterday, the fund is down about 11.1%. As we sit today, markets are also down today. So I'd expect that to be in the 10.5% range, down for the quarter, 11.5% range for the fiscal year to date period. If we look down the different investments, so we can actually hop over to page 11, quickly just updating on a year-to-date basis. So if you look at how they performed for the quarter, this includes through yesterday's performance. So the Vanguard Institutional Fund, your large cap equity allocation, down about 19%, mid cap down about 21%, small cap down about 23%. Cohen and Steers has held up the best, but they're still down about 4.3% on a year-to-date basis. Convertibles down 21%, international managers down 25 and 19%. If we go to your real REIT fund, down 20%. And then as you heard from Sawgrass, fixed income has not held up any better. The ag, so the Bloomberg Barclays aggregate, is down about 11% on a year-to-date basis, and your high yield fund is down about 12% on a year-to-date basis. So unfortunately, there's really been no reprieve in markets. That is why in our new IPS, we are recommending adding an allocation to private real estate. So private real estate is a fantastic inflation hedge. It provides current income to the portfolio and the upside of some appreciation. So what we've seen over the last 12 months is appreciation within private real estate was about 20% for the 2021 year. That's not our long-term expectation, but we do see income being in the 4 to 5% range. We do see long-term appreciation being in the 3 to 4% range. So an allocation to private real estate, our longer-term expectation is anywhere from 7 to 10% returns, depending on the appreciation side of the equation. And so that puts us right in line with our assumption rate, whether we stay at 7.5 or lower it. And so that helps us give us a little bit of diversification in the portfolio to move some money away from both equities and fixed income and provide a different stream of performance in the portfolio. And what I'll quickly highlight on is just within private real estate, keep in mind from an appreciation standpoint in an inflationary environment, new buildings. So you're buying into an existing portfolio of commercial real estate assets across the board, office, retail, multifamily apartments, industrial. You're buying into an existing portfolio of buildings. And as inflation increases, so the price of raw materials, the price of labor increases, new buildings that are going up increase the replacement cost of those existing buildings. And so those existing buildings, their value appreciates to that new replacement cost. And so that's what we saw last year. We expect that to continue going forward, certainly not at the pace that we saw with 20% appreciation, but comfortably estimating in that 3 to 5% appreciation on an annual basis is certainly attainable. And so from an asset allocation standpoint, our recommendations are, you can see what's pulled up, give me 1 second, that we would be increasing our current allocation to large cap, going from 15% up to 25%, which is actually in line with where you're currently allocated. So as of right now, you're overweight, but adjusting the IPS, you would be right in line with this target. We would actually lower mid cap and small cap. So we would go from 10% allocation to mid cap to 6%, and then from a 7% allocation in small cap to 6%. We would not touch the convertible allocation or the REIT allocation. Likewise, infrastructure would stay the same. Your international allocation would stay the same. We would add a 7% allocation target to private real estate. And then we would raise 7% from your fixed income, your core fixed income portfolio. So that would move from 25% down to 18%. We would also lower your high yield allocation from 5 to 4. and then lower the cash allocation from 5% to 1%. And so in addition to those new target updates, we've also added ranges. So you'll see to the right of the targets, those are ranges. And so that just helps provide some flexibility in the portfolio. So if markets are doing well, then we want to maintain an overweight to equities or an overweight to international. We have that ability. And then vice versa. We have some discipline in terms of when markets sell off like they are right now. When we get to a certain level of being underweight, it allows us the discipline to start rebalancing back in and getting closer to our target allocation. And so as you see in front of you, this is the recommendation for our new asset allocation. And so I'll pause and open it up for a discussion and any questions that you may have.
I had a quick question. Hey, Dwayne, what do you think? What do you think about that? You know, in terms of what Mitchell said.
I agree. Burgess and I have talked about this new allocation and ranges, and I agree with it. And I especially like the 25% to the S&P 500. And a lot of pension funds use private assets because you have a long time horizon. You are in a unique position to use private real estate, and you can get decent yields in that area. So I like that. Otherwise, I mean, I agree with what he said. I think this is a good move for you.
Thank you, sir.
Mitch, I was curious, how has the private real estate just within the last year, based on your information, just come to the point to where you guys think we need to get involved with it, or?
Sure. So going into the pandemic, we were a little hesitant in terms of adding new private real estate allocations or increasing where we currently have existing private real estate allocations, especially within the office sector and the retail sector. With things shutting down, we expected to see higher default rates in terms of tenants paying off their leases, but that simply wasn't the case. And since then, we've seen a huge explosion, specifically in the industrial space. So consider a company like Amazon trying to get closer and closer to the end consumer, trying to drive down the time it takes for them to have a customer order something and then receive it. So about 8 years ago, they made a push to do 2-day shipping. Most recently, they've started to make a push to do same day delivery. So you order it at 9 a.m. and it's at your house by 5 p.m. that day. And so with that, we've seen a huge explosion in the industrial space where they're building out and buying more warehouse space to get closer and closer to the end consumer. On top of that, other retailers really felt the pinch with supply chain issues and constraints in 2021. And so they as well have really been pushing into the industrial space to be able to store more inventory and meet the demand of consumers that they simply weren't able to keep up with in 2021. So we think, we wish hindsight, obviously, we would have been able to add to it a year ago. But going forward, there's still significant tailwinds behind it. I mentioned the appreciation side of it, but also with incomes as new leases come up in an inflationary environment. These property owners and property management companies are going to be able to increase their rents and lease terms going forward. And so that's also going to stabilize that 4.5% income we're expecting and potentially increase it going forward. And so as a diversifying asset in the portfolio, hindsight's 2020, obviously we would have loved to add it last year, but going forward, we still think it's going to be a big winner in the portfolio. And keep in mind, it's not as liquid. It's not traded daily like equities or even your REIT investments. So it's a lot more stable stream of return. So you're not going to see the volatility on a daily basis where it's up 5, down 2, back up 1. These properties are valuated on a quarterly basis. And so that's what you'll receive, the updated appreciation numbers. And then the income comes in on a quarterly basis as well. So it's a lot more stable, a lot less volatile than some of the other more liquid portions of your portfolio.
Okay, thank you, Mitch.
And then with that, I would just ask a motion to approve the new investment policy statement if the board is comfortable with it. And then at the next meeting, so we're not going to make the July 1st capital call. So the next capital call to invest in private real estate will be October 1. So that'll give Burgess time to bring you the analysis of the private real estate manager that we're recommending, give you some insight into the properties and areas that they invest, and then be able to meet before that October 1 capital call and be able to allocate there.
We'll entertain a motion to accept Mitchell's report.
Yeah, I'll motion to approve the Burgess report and to also approve the investment policy as presented.
A second.
Second by Kenny Sugden. All in favor?
Aye.
Opposed? Motion carries unanimous.
Thank you, Mitchell.
Thank you, sir.
Thank you.
On to Mr. Bond.
Thank you.
Well, hello, everybody. I'm here for Anna. She and her family are suffering from COVID. So we do wish them a speedy recovery, but I'm here to give you her report. So the first thing that I want to talk about is that we created the addendum to the agreement for the actuarial services for the Foster and Foster contract. There are 4 changes that are on here. So the first one is just adopting that new fee schedule that they provided to you and that you approved at your last meeting. The second thing is just updating the contract for the contacts for termination and notices that occur in the fund. So updating to Jill as the administrator, updating to Anna as the contact for the attorney's office. Actually updating to Patrick Donnellan. It's been that long since you've updated your agreement with them. So to take out Ward Foster as the contact. The third change is to include the public records language that is required by the Florida statutes. So since you last amended the contract, there were 2 laws that were made required changes to contracts that governmental entities enter into. So this first one is with regard to public records and the responsibility of the actuary to, and anybody who's entering into a contract with you, the responsibility that they have to assist in the responses to public records requests, as well as the responsibility to turn over documents at the end of the contract in a form that you can use them. There's also language on there about the contact, if you have any questions about the public records law, or if they have any questions, who they would contact. The final change is something that happened at the beginning of 2021, which is that all entities that enter into contracts with or have contracts with governmental entities need to use the E-Verify system to determine the work status of individuals who work with the plan. So unless you have any questions, it would be appropriate to make a motion to execute the addendum to the agreement with Foster and Foster.
I entertain a motion.
Okay.
Accept the addendum.
Motion to accept the addendum to the agreement with Foster and Foster.
Second.
Motion second by Kenny Sugden. All in favor?
Aye.
Aye. Any opposed? Motion carries.
The next item that I wanted, thank you very much, by the way. The next item that I wanted to update you on is just really an educational update. So a couple of things happened at the federal level. The required minimum distribution age was increased to 72 at the end of 2019. The legislature continues to consider the required minimum distributions. So a bill passed the House, which would increase the required minimum distribution age to 75. It has not yet been considered in the Senate. So we'll keep you updated as that moves forward. Just wanted you to be aware that there are movements afoot to make some additional changes to public sector pensions. One of the other things that has happened with regard to the required minimum distribution age is some regulations that were issued by the Internal Revenue Service. So there are a couple of groups who benefit from the required minimum distribution provisions. So they treat spouses favorably with regard to when they need to withdraw money and how they can use that required minimum distribution age. Individuals who are not spouses, who are entitled to benefits, have a shorter period under which they have to take the money out and move it and pay taxes on it, really. And so what the IRS did was that they looked at the groups of people, and they saw that in the group that did not have the favorable treatment were people who were dependent upon the retiree for income because they were unable to be gainfully employed due to mental or physical reasons. Largely, those are children with disabilities or parents who may depend upon that retiree. And so they've moved them into the favorable tax treatment category. I'm not expecting any of you all to remember this. I just want you to know that, you know, there is at least some movement to look at how this impacts real people, and that the IRS has made a move that I think is beneficial for people who need that provision. The last thing in the educational update is just what's happening in the private sector. The Department of Labor has expressed some concerns about cryptocurrency as an investment in pension plans. They don't think that it should be in a defined benefit plan. They don't think that it should be available on a defined contribution platform. And they also do not think that it should be available in a defined contribution plan in a brokerage window. I'm not going to talk to you about it anymore because I don't think that Burgess Chambers is going to bring it to you as a possible investment. But I am available, and Mitchell's here to answer any questions that you might have about it. All right, hearing none. The last thing I want to do is to remind you that your Form 1s are due tomorrow. You do have a couple of month grace period until September, until they start charging you. But you know, the earlier you get it done, the quicker it's off your mind. We do recommend that you file it in a way that you can prove that you have filed. I know many of the supervisor of elections across the state are accepting them via email. I also understand that they are beta testing the ability to file it online. So you would be able to fill it out and submit it online. It's not yet widely available, but they are testing it with the elected officials. So we'll keep you updated on that as well. And that concludes my report.
Thank you, ma'am. Accept the motion to accept Ms. Bonnie's report.
Okay. Motion to accept the report.
A second.
All in favor?
Aye.
Any opposed? Motion carried. Okay. Thank you, ma'am.
Welcome.
Yep, sorry.
Sorry. What we're looking at now is the quarterly expense report that I keep. just showing you the invoices that have been paid and the deposits that have been made into the contributions, the city contributions and employee contributions by month. Nothing very unexpected in this. But I will need a motion to accept it.
Okay. Motion to accept the expense report is presented.
I second.
All in favor?
Aye.
Any opposed? Motion carries. Thanks, Joe. Any public comment?
There
Seeing-
is none.
Seeing none. Any other business? Can a motion to adjourn?
Oh, motion to adjourn.
I second.
Second by Kenny Sugden. Favor, say aye.
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 Thanks, guys. Appreciate your time. Really.
Hi,
you.
thank you.
Thank you
All right,
all very
thanks.
much. Happy 4th of July to everybody.
Yep.
Happy 4th.
Y'all have a good weekend
Thank you.
too.
Happy 4th.
Happy 4th. Bye.